In the world of economic forecasts, the UK has received a modest but meaningful upgrade. After months of uncertainty and cautious predictions, this new outlook is a welcome change for many who have been closely watching the nation's financial health. It signals that, while challenges remain, there are signs of improvement on the horizon. The Confederation of British Industry, or CBI, now expects the economy to grow by 1.4% in 2025, up from 1.2%. This may seem like a small adjustment, but in economic terms, even a fraction of a percent can have a significant impact on jobs, investment, and public confidence. For 2026, the forecast jumps to 1.3%, a notable revision from the previous 1.0%. These numbers reflect a cautious optimism, suggesting that the UK economy could be turning a corner after a prolonged period of stagnation and slow growth. This shift is driven by updated data and new government spending plans announced by Finance Minister Rachel Reeves. The government's commitment to targeted investments and fiscal support has played a key role in shaping these improved projections.
Even small percentage changes mean billions for the UK economy, so these upgrades matter. They can influence everything from business expansion plans to consumer spending habits, and even the government's ability to fund public services.
The improved outlook offers a brief respite after a period of stagnation, providing hope to those who have felt the pinch of slow growth and economic uncertainty. It hints at more stable ground for businesses and households, suggesting that the worst may be behind us, at least for now. For families and entrepreneurs, this could mean a little more breathing room and a chance to plan for the future. But this growth is fragile, heavily reliant on government action, and not yet a sign of a robust recovery. The risks of global instability, inflation, and policy missteps still loom large, threatening to derail progress. The CBI's message is one of cautious optimism. The economy is inching forward, not surging ahead. Business leaders and economists alike are urging vigilance and careful planning as the country navigates this delicate phase. These upgrades influence confidence, but the underlying reasons for optimism deserve scrutiny. It's important to look beyond the headlines and understand what's truly driving these changes. The real story is more complex than the headline numbers suggest. As the UK moves forward, the path to sustained growth will depend on careful policy, global trends, and the resilience of its people and businesses. The upgraded 2026 forecast is largely thanks to the November budget from Finance Minister Rachel Reeves. Her announcement was met with anticipation, as many hoped it would signal a turning point for the UK economy after a period of stagnation and uncertainty. The budget increases government spending, injecting much-needed cash into the economy and providing a short-term boost. This surge in public expenditure is designed to stimulate demand, support public services, and reassure both businesses and households that the government is taking action.
The CBI credits this fiscal stimulus for lifting growth from 1.0% to 1.3%, but it's a temporary lift. Economists warn that while the numbers look better in the short run, the underlying issues facing the economy remain unresolved. To fund this, the government is raising taxes on workers, pensions, and investors, offsetting some of the benefits. For many, the extra money in public services is balanced out by higher deductions from paychecks and reduced returns on investments.
The result is a delicate balancing act: more spending, but also more taxes, so the net effect is limited. The government is walking a tightrope, trying to support growth without letting debt spiral out of control.
The CBI's chief economist, Louise Hellam, says the budget prioritizes stability over long-term growth. She points out that while stability is important, it's not enough to transform the UK's economic prospects. There are few incentives for business investment or productivity improvements. Without bold reforms or targeted support for innovation, the private sector may remain hesitant to expand or hire.
The boost is like a shot of caffeine, energizing but short-lived. It may help the economy get through the next year or two, but it won't address deeper structural challenges. The government's cautious approach stabilizes finances, but risks leaving the economy stuck in a low-growth cycle. Without a clear strategy for long-term expansion, the UK could fall behind its global competitors.
It's crisis management, a necessary response to immediate pressures, but not a vision for the future, not a blueprint for lasting prosperity. The country needs more than short-term fixes to secure its economic future. The real challenge is to spark private sector investment for future growth, creating jobs, boosting productivity, and ensuring the UK economy thrives in the years ahead.
Despite the upgrades, the mood among business leaders is best described as cautious optimism.
The threat of recession has faded, but a booming economy is still out of reach. Progress will be slow and hard-won, not rapid or transformative. Growth is driven by government spending, not private sector innovation or trade.
For families, higher taxes may offset any gains from public spending, leaving little change in their finances.
Inflation remains above target, and interest rates are still restrictive, so life stays expensive. The optimism is relief that the worst is over, not a sign of prosperity. Small businesses may cautiously hire, families may spend a bit more, but big risks remain.
The narrative has shifted from crisis to slow recovery, but the journey ahead is uncertain. Comparing the UK's outlook to other major economies provides context. The CBI's 1.3% growth forecast for 2026 now matches the IMF and OECD, signaling consensus.
This alignment reassures that the UK isn't an outlier, but it also means the UK isn't leading the pack. Like its peers, the UK faces post-pandemic challenges, high inflation, and global uncertainty.
The UK's growth is solid but unremarkable compared to its pre-2008 performance.
Slower growth means tougher debates over public spending and living standards. The UK is neither the sick man nor the engine of Europe, just one of many advanced economies facing headwinds.
The budget boost keeps the UK in line for now, but the real question is how to lift long-term growth above this modest average. Without new policies, the UK risks being stuck in the middle of the pack.
Inflation remains a stubborn challenge for the UK economy, with the CBI forecasting a rate of 2.6% in 2026, still above the Bank of England's 2% target. Despite efforts to bring it down, inflation has proven difficult to tame, and the latest projections suggest it will linger longer than many had hoped.
This means the cost of living will keep rising faster than the central bank would like, eroding the purchasing power of everyday people. For many households, this translates into higher prices at the supermarket, steeper utility bills, and less money left over at the end of the month. The impact is felt most by those already struggling to make ends meet.
The causes are complex and interconnected. Lingering supply chain issues from the pandemic, volatile global energy prices, and wage growth that's outpacing productivity all play a role. These factors combine to keep upward pressure on prices, making it harder for inflation to fall back to target levels.
The CBI expects inflation to remain sticky, meaning it will be slow to decline and difficult to bring under control. This persistent inflation complicates economic planning for both policymakers and businesses, who must navigate an uncertain environment.
For households, even modest inflation adds up over time, especially for those on fixed or low incomes. Every price increase chips away at savings and makes it harder to afford essentials, putting extra pressure on vulnerable groups.
The CBI's outlook is more pessimistic than the Bank of England's, suggesting that price pressures will persist for longer than previously anticipated. This divergence in forecasts highlights the uncertainty facing the UK economy. If inflation proves stubborn, the Bank of England will have less room to cut interest rates, keeping borrowing costs high for families and businesses. This could slow economic growth and make it harder for people to manage debt.
The fight against inflation will shape decisions from the central bank to the kitchen table, influencing everything from interest rates to how families plan their weekly budgets. It's a challenge that affects everyone, regardless of background.
High inflation remains a central risk to the UK's economic recovery, threatening growth and putting additional strain on households and businesses as they navigate an uncertain future. The inflation outlook directly affects interest rates set by the Bank of England.
The CBI expects only 2 more quarter-point rate cuts, bringing the bank rate from 4% to 3.5% by early 2026. Even then, rates will remain well above the near-zero levels seen after 2008.
This means borrowing will stay relatively expensive, keeping a brake on the economy.
The CBI's view is more cautious than many economists, who expect rates to fall further.
The era of ultra-low interest rates is over. Both households and businesses must adjust. The bank must balance cutting rates to support growth with keeping inflation in check.
The future path of rates is uncertain, but the message is clear: expensive money is here to stay.
The Bank of England's challenge is to avoid reigniting inflation while not stifling fragile growth. Higher taxes, persistent inflation, and elevated interest rates are squeezing UK households.
Workers will see more of their pay go to taxes, and pension changes could affect long-term savings.
Inflation means everyday essentials keep getting pricier, eroding any wage gains.
Many families feel like they're running to stand still. Nominal pay rises don't translate to real gains.
Higher interest rates mean bigger mortgage payments and tougher borrowing conditions.
For first-time buyers, home ownership is even further out of reach.
The combined effect is a continued squeeze on living standards, despite positive GDP headlines. Many won't feel the benefits of growth at home, fueling frustration and insecurity. The disconnect between national statistics and personal finances is a key challenge for policymakers. The CBI's analysis highlights the difference between a temporary boost and lasting progress. The November budget provides a short-term lift, but doesn't address the UK's deeper economic challenges.
Sustainable growth requires more than government spending. It needs private sector investment and productivity gains.
That means investing in technology, skills and infrastructure, not just one-off cash injections.
Future policies must make the UK more attractive for business, with tax reform and less red tape.
Addressing skills shortages is also crucial for long-term prosperity.
Without a long-term plan, the UK risks slipping back into stagnation once the stimulus fades. The upgraded forecast is a window of stability, but real reform is needed for lasting growth. The UK's revised forecast for 2026 is a temporary reprieve, not a lasting cure. Growth of 1.3% is welcome, but it's driven by short-term government spending, not structural change.
The November budget was a balancing act, raising taxes to fund spending, not to spark private investment.
Once the stimulus fades, the UK faces the same challenges: low productivity, weak investment, and squeezed finances.
Households will still grapple with inflation, high rates, and higher taxes.
Many won't see real improvements in living standards, despite better GDP numbers.
The era of expensive money continues, demanding new financial habits. The real test is whether this stability is used to implement tough, long-term reforms. Without a credible plan for investment and productivity, this boost will be fleeting. The celebration must wait for signs of genuine, sustainable recovery.